Hey YouTube, so in this video I wanted to cover how do you pay yourself when you are the sole owner of a single member LLC. So LLCs can be taxed in a variety of different ways, and so depending on how your entity is taxed, what are the terms of your operating agreement, that's what's going to drive how you pull income from your company. Right, so just to start, a single member LLC is by default a disregarded entity. So what that means is the entity still legally exists under state law. It can enter into contracts, it can sue people, it can be sued, but the entity is disregarded for federal tax purposes in that it's completely transparent. So any income that you earn through the entity is attributed to you personally as the owner. So a single member LLC that's running an active trader business with a sole individual owner, all of that activity is reported on a Schedule C every year, which is attached to your personal Form 1040 tax return. Now, because it's a disregarded entity and everything kind of flows through the owner personally, you can kind of take out cash as you wish, right? You don't need to have a formal payroll system where you're on the payroll, you're earning a wage, and you have federal withholding, payroll taxes, all that stuff. That doesn't apply to you. So you can just take cash out as a distribution, that's okay. Now the one limitation is if you have an LLC operating agreement that has terms that restrict when cash can be distributed, then you need to follow those. So for example, if you have an article in your operating agreement that said something to the effect of you can only distribute cash to owners once every quarter, okay, now you got to comply with those terms. So follow whatever's in your operating agreement. If you don't like what's in there, then you can amend it. But you should do everything in there to, follow the rules of whatever you originally signed on to when you created this entity. So the other option is a single member LLC that's taxed as an S corp. So an S corp is a federal tax election. You can file this for an LLC. You can file it for a corporate entity. What effectively it does is it still treats the entity as a pass-through entity for tax purposes, but it files its own tax return, and the earnings that pass through to the owner are only subject to federal income tax, not self-employment tax. And because it's not subject to self-employment tax, the owner that participates in the business needs to be on the company payroll, right? So if you're an owner of a LLC S corp, you need to be on the payroll, so you get a W-2, you have payroll taxes coming out of your paycheck, you have federal withholding coming out of your paycheck. You need to follow all the same rules that any other employee would have to, right? So that's the first way you can get paid. The second way is you can take cash distributions as dividends, right? So S corps can distribute cash to their shareholders as a dividend distribution. The dividends themselves aren't really subject to tax necessarily. It's just a return of capital, and it reduces your tax basis in the S corp stock. Now, the basis is important because if you receive cash as a dividend distribution and it's in excess of your basis, so it puts your basis into a negative number, that can create a capital gain tax, right? So you need to be very careful of tracking your basis when you have S corp stock to make sure you don't fall into that trap. The third one is a single member LLC taxed as a C corp. So you don't see a lot of these, but they are frequent for non-resident owners of an LLC. So the payroll situation applies just like the S corp. If you're an owner and you're actively running the company, you should be on the payroll. So you get a W-2, payroll taxes, the whole nine. You can also get dividend distributions, much like the S corp. However, dividend distributions from an entity taxed as a C corp come out of accumulated earnings and profits, and when they're paid to you as a dividend, that is income to you, right? So you have to record those dividends on Schedule B of your tax return when you file your Form 1040, and you pay taxes on the dividend income. Now, the rate at which you pay tax depends on your holding period of the stock, right? So if you own the stock for more than 60 days during that 121-day period, you can treat the dividend income as qualified dividend income. And the reason that's appealing is because qualified dividend income is subject to the long-term capital gains rates. And those rates are 0, 15, or 20, depending on where your AGI is. So if your AGI is high, you might fall into that 20% bucket. If it's lower, you might fall within that 0, 15. It really just depends on where your AGI is. But either way, it's good to have the qualified treatment because you get the lower tax rate rather than your ordinary income tax rate. So that covers the basics on how to pay yourself out of a single member LLC. As you can see here, it really depends on how the entity is taxed, how is it structured. Hopefully it was helpful to you. If you have any questions, please leave me a comment below on the video. Happy to answer those. And of course, if you can give me a like on the video, I always appreciate it. And if you're not subscribed to the channel, go ahead and subscribe already. And I hope to see you again soon. Thank you.